Right, we are now going to look at a few additional important principles that you need to know. Now, the first one will be our deferred tax asset. Remember, we have identified if there is a deductible temporary difference, we may recognize a deferred tax asset. But now we're going to take this one step further. The standard indicates to us that we may only recognize this deferred tax asset if it is probable that there will be future economic benefits to be able to utilize, to be able to use the deferred tax asset. Therefore, it is important that you read a scenario carefully. We may only recognize the deferred tax asset if it is probable, more likely than not, that there will be future taxable profits. Now, in terms of assessed losses, remember, we will cover this in the next lecture. Then the second important principle, tax rates to be used. We need to measure our tax rate that will be expected to apply to the period when the asset is realized or the liability is settled, based on our tax rates, tax laws that have been legislated or substantively legislated by the end of our reporting period. Now, let's just recap this again. Then you don't have to look at this in future. Remember, we have the beginning of our year, therefore let's say that this is our year end for 2021 and this is our year end for 2022. Right, therefore our opening balance will be on 1 March. Our year end is February, and our basic example here. Okay, now they indicate to us, for example, currently our tax rate, let's say that this is 29%. But now the tax rate will increase to 30%. Basic example, guys. Read the scenario to get these rates. Now, for this period, our current tax will be based on our profit and loss. Remember, your current tax, base profit and loss. Therefore, this is for a period. We use our 29%. But our deferred tax will be based on our statement of financial position, and this is at year end. Therefore, we need to ensure that our balance, will be based on our 30%, the new rate at year end. Now, I've included a summary here at the bottom. If there is a tax rate change, remember, you will have to include this in your income tax expense note, your tax rate recon, your deferred tax calculation. Look at this, not your deferred tax note. You use your temporary difference of your deferred tax calculation times your new rate. Remember, in your deferred tax note. I'm going to share this to you just now. Right, then number 3, foreign taxes. Your relationship between your tax expense and income and your accounting profit or loss may be affected by certain factors, whether revenue is exempt from tax or expenses is not deductible, and this, or it can have an effect on your tax loss and your foreign taxes. Extremely important to read a scenario. We have included this in our example in terms of Pink Limited. If there is a foreign tax, think about your journal entry. You will credit your tax payable in your foreign entity. And very important, if you look at this journal here, income tax expense, profit and loss, you need to read a scenario. It can indicate to you that the tax is already deducted in an amount, or you still have to deduct this. Therefore, I don't want you to study this journal. I just want you to ensure that you read carefully. If there is foreign taxes, the standard indicates to us that we will have to include this in our income tax expense note. Therefore, again, I've included the three sections which will be affected by foreign tax: your current tax calculation, your income tax note, and your recon. Then number 4, over or under provision of such. Let's have a look at an extremely basic scenario. I'm sure you have dealt with some taxes. Remember, you have a first provisional payment and a second provisional payment. Now, if we include a timeline and your first provisional payment is August 2017 and you had to pay 100,000. Year end is Feb 2018, second provisional payment, and you have to pay 150,000. The total amount that you have already paid is 250,000. Therefore, if you think about your journal entries, debit, credit, debit your provisional payment, and the total will now be the 250,000 if I add the journals, and you have credited your bank with the 250,000. Right. But now your financials are finalized and you have identified that the current tax that should be paid is 260,000. But we have only paid 250,000, but we should have paid 260,000. Do you see we have under provided for our tax? This is an under provision of 10,000. Again, this will influence your income tax expense note as well as your tax rate recon, and you can refer to Shakes Limited. There is a similar scenario included.